If this cycle were to worry, we tend to think we're going to have a harder landing than most economists do. If the cycle were to hit it, and Nvidia surprisingly gets hit very hard by cycles because the inventory buildups, and I would say we're in one of those right now, are so spectacular. If we have a combination of a correction and the recognition by the marketplace, perhaps, that some of these models don't have to be as large and don't need as much computing power as more companies use more specialized models. You get the confluence of a reality check. Nvidia is just a very powerful company.
In this video, Ark Invest CEO Cathie Wood discusses why she is cautious on Nvidia and her approach to AI investing. With an eye on high-growth stocks and innovation, the Ark Funds outperformed the market for years during times of peak performance for the leading indexes. Nvidia, the fifth most valuable U.S. company, on Wednesday projected quarterly revenue more than 50% above the average Wall Street estimate and said it would have more supply of AI chips in the second half to meet a surge in demand. However, Cathie Wood says Ark dumped Nvidia shares before 160% surge because it's just pivoting to other AI plays. Nvidia's 165% surge has many winners, but Cathie Wood isn't one of them. Cathie Wood defended her firm's decision to bail on Nvidia Corporation before the chipmaker's shares surged 160%, saying the computer chip industry's boom-bust cycle poses risks. Wood's flagship Ark Innovation ETF cut its holding in Nvidia in January and missed out on most of the rally that added more than $500 billion in market value. Cathie Wood's Ark Invest sold most of its Nvidia stake just before the chipmaker kicked off a rally that added $585 billion in market value. Too rich for Cathie Wood, Nvidia shares stretch valuation limits. Recent results at Nvidia have heightened expectations for AI servers, SMBC Nikko Securities analysts including Takeru Hanaya wrote in a note. Still, there is a contrast between AI expectations and overall market weakness, demonstrated by ongoing price cuts and inventory adjustments in the chip industry. Cathie Wood of Ark Invest says that the ruling giants of the technology industry are at risk of being disrupted by artificial intelligence. Wood said in a tweet on Monday that the world's most valuable chipmaker is priced ahead of the curve. As few years ago, the Ark Innovation ETF was betting big on Nvidia. Cathie Wood's ARKK bet big on Nvidia, then missed its meteoric rise. Before proceeding further in this video, make sure to hit the subscribe button below for more recent updates about crypto market.
We're very positive on Nvidia. We have been very positive on Nvidia. We bought it down when it hit nearly $100 in the fourth quarter last year. And then it tripled as some of our other AI-oriented stocks stood still. So, we're looking at, believe it or not, many people do not believe this about us. We're looking at relative valuations of names in the AI space. And we were looking at Nvidia at 25 times sales, which is where it is. And Tesla, which is probably the biggest AI story out there, is at 6 times earnings. UiPath yesterday, not earnings, 6 times sales. UiPath yesterday reported it is a beautiful AI play. It too is at 6 times sales. And as far as Nvidia goes, there are a few reasons we take some pause. It still meets our minimum hurdle rate of return, so 15% at a compound annual rate over 5 years. And so you'll see it in some of our more specialized portfolios.
Yeah.
We're looking for the better values. But the risks to Nvidia would include cyclical. When I hear shortages about GPUs or anything, I begin to think about the cyclicality of a group. Competition. Tesla is coming up with its own chip. Meta Platforms, Google, their own chips for more specialized large language models. And then the tech itself. We're learning from Meta Platforms, the Llama model is able to do with less computing power, but more data.
Yeah.
It's able to deliver better models. So there are puts and takes here, as there always are.
How many frustrated investors have got in touch with you via Twitter or the other forms in which you connect with your own purchases of the ETFs? I mean, there must have been a lot of frustration that you kept it in some funds, but not the main ARK ETF.
Well, I'll tell you what has happened mostly is people who understood the Nvidia story. We were pounding the table on it on 2014, really till 2021. And many people actually put it into their portfolios, their own portfolios, and they may have held it. We have not gotten much pushback. And the reason is people know that we are on AI, but we're doing it in a little bit of a differentiated way. Nvidia has become a check the box stock. That's why the valuation is where it is. But we are looking for those plays that have not only the vision from management team point of view and broad distribution, but also proprietary data and AI expertise. So we're just pivoting to another set of plays that most people have not discovered yet, much like they did not understand that Nvidia was an AI play really until very recently. So it could be disintermediated as if consumers use ChatGPT and other AI tools to say, I want exactly this kind of item at the cheapest price anywhere in the world. And it would go directly to that source. So, any platform that has served as, an intermediary is at risk, we would say.
Tesla to the moon? Elon Musk hints Nvidia's large-cap dominance is only for now. Tesla bear Gordon Johnson, who has a sell rating on the stock, has a price target of $24.33 for the stock. But bulls, including Ark Invest's Cathie Wood, have great expectations. Ark expects the stock to hit $2,000 by 2027, premised on the yet-to-be-launched robotaxi services contributing about 58% of the expected enterprise value and 45% of the expected EBITDA by 2027. Barron Capital's Ron Barron sees the stock reaching $1,500 by 2030. Cathie Wood explains her reasons for being cautious about the group and her approach to investing in AI. Nvidia trades at 25 times sales, while Tesla or UPath trade at around 6 times. And the stock is subject to cyclical risks. The problem for the Ark Innovation ETF is that, as with the wider tech sector, its performance is closely tied to expectations of U.S. interest rate rises. That undermines any reputation for picking stocks. Predictions that the Fed has stopped raising rates for now have renewed interest in tech stocks. This is a massive shock to the system, Wood says. The economy now has a higher probability of a deflationary bust rather than inflationary boom, she adds.
The autonomous taxi network that we believe Tesla is building, it has more data. Talk about proprietary data. It has more data of real-world driving miles than all of the other auto companies and technology companies like Waymo put together around the world, we would say, except for perhaps China, because we don't know exactly what's going on there. And we do believe that the autonomous taxi platform opportunity is a winner-take-most opportunity. The company that gets a person in an autonomous vehicle from point A to point B as quickly and safely as possible is probably going to get the lion's share of the market. And that company will, in the United States, we believe, be Tesla. And we believe globally that opportunity will scale from zero today to $8 to $10 trillion in revenues by 2030. So you can see why we're so excited by Tesla. It is the furthest advanced from an AI point of view, and it's even becoming a manufacturer of factories using artificial intelligence and becoming more and more and more efficient in manufacturing factories and cars. We think it's the most efficient in the world right now. With our 5-year investment time horizon and having been around this block a number of times, we know they're going to come to a deal. They are not going to deprive government employees of their paychecks, Social Security, so retirees of their paychecks. It'd be politically disastrous as we're heading into this election year, and already the field has heated up so significantly. So they're going to get through this. It's a very short-term phenomenon. It might be a short-term fix. And hopefully they do get serious about this at some point in time, but we don't think now is the time. You start looking at these charts in history, this decline will look very like it was very rapid and we will descend into deflationary territory. Don Luswin wrote a piece, it was an editorial in the Wall Street Journal, I believe, about this. And I think the Fed is going to be blamed for sending us into a deflationary period. Already we're getting negative signs for guidance. Home Depot, its same-store sales down 3 to 5% for the year now they're expecting. We got GDI, which is the other side, so gross domestic income, which is the other side of gross domestic product. And they need to equal, but they're at a record gap right now. It's been negative, so in recession territory for the last 2 quarters. And I think many companies are going to feel a hard landing, and it's going to come both from units and prices. I think more and more companies are reporting this on their earnings report. These economic statistics that take all the oxygen out of the room are hugely lagging, and they're not even getting it right.
Earlier this month, Ark Invest was spotted accumulating large amounts of Coinbase stock, apparently bullish on the largest crypto exchange in the US. Nvidia close to becoming first trillion-dollar chip firm after stellar forecast. The chip designer's shares extended their rally this year on Thursday, soaring about 28% after a stellar outlook showed that Wall Street has yet to price in the AI potential of the company that has already doubled in value in 2023. On the other hand, Intel risks being left behind as Nvidia ups a lead. On this note, we conclude our video. Do you agree with Cathie Wood's outlook about Nvidia, Tesla, and her opinion on upcoming deflation? Share your thoughts in the comments section below. If you found this information helpful, then like this video and subscribe to our channel. We will bring you more updates in the future.